Hello, I'm Haider Malik, host of the Mehmi Financial Group podcast. Today's topic is lease versus buy financing Edmonton construction fleets and equipment. Whether you need dump trucks, excavators, or aerial lifts, choosing to lease or buy profoundly affects your cash flow, tax position, and operational flexibility. Let's explore the key factors so you can make the optimal decision for your Edmonton projects. 1. Capital outlay and cash flow. Buying. A down payment of 10 to 20% of purchase price ties up significant cash. Monthly loan payments include principal and interest, and you assume full ownership costs. Leasing. Operating leases typically require little or no upfront cash and spread payments over 36 to 60 months. You preserve working capital for fuel, materials, and labor, essential when winter draws out projects. 2. Balance sheet and tax treatment. Owned equipment. Recorded as an asset with a matching liability. You claim full capital cost allowance, depreciation, and deduct loan interest, which can improve after-tax cash flow. However, increased debt may affect your leverage ratios and borrowing capacity. Operating leases. Lease payments are fully deductible as operating expenses and, under IFRS or ASP, may remain off balance sheet. This boosts EBITDA and keeps debt-to-equity metrics lower, important when bidding on large municipal or oil patch contracts that require strong financial ratios. 3. Total cost comparison. Loan path. Calculate principal plus interest over the term, add maintenance reserves, insurance, and expected resale value. Edmonton's freeze-thaw cycles accelerate wear on hydraulics and undercarriage, so factor higher service costs. Lease path. Some all lease rentals, bundled maintenance fees, overage charges, hourly use caps, and potential end-of-term wear and tear penalties. Compare that to your loan total cost figure using net present value analysis. 4. Flexibility and upgrade cycles. Purchase. Best if you plan to use the equipment beyond 5 to 7 years. Common for core loaders on long-term civil jobs. You capture any residual value on sale and avoid repeated lease fees. Lease. Ideal for technology that evolves, telematics-enabled excavators or electric site vehicles, or for specialty equipment needed only per project phase. At term end, simply return or swap for the latest compliant model without disposal hassles. 5. Maintenance and downtime. Owned units. Maintenance is on you. Negotiate service contracts with Edmonton area dealers for priority during peak seasons. Budget a dedicated reserve for unplanned repairs like hydraulic pump rebuilds. Leased units. Many operating leases include preventive maintenance and emergency support. In Edmonton's cold months, guaranteed breakdown assistance and pre-season inspections can be worth the premium. 6. Borrowing rates versus lease factors. PASAI. Loan rates. Currently hover around prime plus 1% for well-qualified construction firms, longer amortizations, lower monthly payments but increased total interest. Lease factors. Operating lease rates, roughly 2 to 3% of equipment cost per month. Finance leases blend loan and lease. You enjoy depreciation benefits but pay a slightly higher all-in rate. 7. Decision framework. 1. Cash flow modeling. Project 60 months of payments, loan versus lease, against your expected Edmonton season revenue, including winter slowdowns. 2. Scenario stress test. Model a 20% drop in project draws or a 30% spike in maintenance. Ensure whichever option preserves your debt service coverage ratio above 1.25x. 3. Residual value assumptions. If you own, estimate resale based on Edmonton's used equipment market. If you lease, confirm realistic end-of-term buyout or return conditions. 8. 3 action steps. 1. Audit your fleet plan. List equipment types, intended useful life, and upgrade cycles. 2. Gather financials. Compile PPAS and Ls, balance sheets, and equipment usage data. Then approach banks for term loan quotes and dealers or captive lessors for lease proposals. 3. Compare true cost. Use NPV or IRR analysis, incorporating all tax impacts, maintenance, and residuals. Choose the structure that aligns with your cash flow dynamics and growth objectives. In Edmonton's competitive construction landscape, the lease versus buy decision isn't one size fits all. By carefully evaluating cash flow effects, balance sheet impact, total cost, and operational needs, you'll finance your fleet in a way that maximizes uptime, preserves liquidity, and positions your company for sustained growth. I'm Haider Malik. Thanks for listening, and here's to building a stronger, smarter fleet financing strategy.